Welcome everybody to Module 2, Foundation, Session 3, Cash Flow Cycles. Now, in the first two sessions of this module, we went over the core foundation items, then we went over the actual financial statements themselves. Now we're going to go over the cash flow cycles. Now in particular, we're going to go over the two main cash flow cycles that truly are going to affect your business. But I wanted to put this particular item here in this module, in the foundation module, so that you can see first, what are the cycles, and then how do they affect them statements. So what we're going to do is, if you still have that core financial statement template available, please have that ready for when we do this particular session, because we're going to go back into it and we're going to drop some entries in so that you can see how the cycle affects the actual statements themselves. So let's go ahead and begin. So in this session, again, we're going to cover the cash receipt cycle and cash disbursement cycle. Now I know that seems kind of simplistic, but we do need to at least walk through and expose you to the cycle so you understand how those particular cycles work. On the cash flow cycles, of course, not to sound like a broken record, but there are two main cycles: the cash receipt and cash disbursement. Now the cash receipt cycle is your income cycle. So that's when you have a sale and then you send out the invoice if it's going to be on credit, or you collect the cash, then you record the information into the system, then you deposit it into the bank, and then you do a bank reconciliation, and then you're back to a sales cycle again. Same thing with cash disbursement. It's going to be you incur an expense, you pay for it, or you record it as an AP if you buy it on credit. Make sure that it's booked into the right account, write a check for it, reconcile your bank account back to doing the expenses again. So you'll also hear these called as the income cycle and expense cycle. They really mean one and the same, and that's why I put these particular brackets in here on the. So cash receipt cycle, like it says, it truly is a cycle, and that's why I have this little graphic here so you can get an idea. It really is, it comes full circle every single transaction. So the very first part on the cash receipt cycle is sale. You either sell it for cash or you have it for credit. Somebody buys it and they're going to pay you in 30 days or 15 days or what have you. So you have that sale, that transaction happens. Then you record the invoice into revenue. And accounts receivable. In this case, in this particular situation, I said it was AR, but you could theoretically have it hit cash as well. You would just technically skip this next step here. But in this situation, we have it hitting accounts receivable, so you have a credit. So you have the transaction, you're going to debit your accounts receivable for, let's say, $100, and then you're going to hit your revenue for $100. So those are your debits and credits. Remember, debits and credits need to balance. Then we get to the next item, your cash collection item. And this is where somebody decides to finally pay you. And by decides, it's all technically their decision. But you get payment on the accounts receivable. And so you collect the cash. And so you record the transaction in the system. But then you go and you get the deposit ready to go to the bank. So you put the bank deposit together. You have, in this case I say cash, but it could, more or less is going to be a check and or maybe a credit card transaction. But you get the deposit ready to be deposited into the bank. Then your bank reconciliation. Now we're going to do an actual separate session in Module 3 where we go over the internal controls on the cash cycle. And pretty much all internal controls related to the cash aspect of your business. And one of the biggest things, and I've done several investigations, forensic investigations, where if the bank reconciliation had just been done, the fraud that was happening in those particular instances would have been caught. And so that's why it's an important step in this cycle is you're going to be depositing the money. Well, probably not you. Your staff's going to be depositing the money in the bank. And then you need to make sure the bank reconciliation is done and reviewed and monitored. And in session 1 of Module 3, we'll go over how to review a bank reconciliation. And then we get right back to the end of that, and then we have the next cycle, the next transaction. So we go through this process again and again, and it just keeps going on and on and on. And so that's how that flows through. And like I said, when you hear cycle, I want you to think of this graph. Now, if you don't sell it, for accounts receivable, your circle is going to be a little smaller because you won't have this step right here. But if you sell it for cash, it just comes here and all the way around, but it's still going to be a cycle. So now let's go into the cash disbursement cycle. Cash disbursement cycle, same thing except for cash is going out or is being dispersed. So in this situation, you request a product or a service. You call up the electrician to come in and fix all the wiring in your office, or you're purchasing a product to be part of your inventory that you're going to sell. Whatever it is, you initiate that transaction. Remember, on our cash receipts, the very first thing was a transaction. This is also going to be geared by a transaction. So then you receive the invoice and you either record it in accounts payable or you pay for it right away. Again, same thing with the receipt cycle. If you have credit, you'll have an additional step. If you have cash, you'll pretty much come over to this step. But you're going to receive the invoice. In this instance, we're saying we bought it on credit, and record it into accounts payable and the respective expense. Then the AP, accounts payable, gets approved for payment. So somebody goes through and reviews, says, yes, we truly did, receive this product, and go ahead and pay XYZ material company for that amount. Then you send the check or wire to the vendor, and then again back to the bank reconciliation. Again, the bank reconciliation is key. Now, you don't do a separate bank reconciliation for your disbursement cycle and a separate one for the cash receipts. It's all intertwined into one reconciliation, but it's still an important aspect of the cycle is a bank reconciliation needs to be done. And then from there, you go to the next transaction. And so this keeps going on and on for every single transaction. You're going to have this cycle. And again, I want you just to keep this in your mind as you're thinking about transactions and how they flow through your books, because this is important for you to understand how it's going to flow through from kind of an administrative standpoint. And now what we're going to do is we're going to do a quick case study, and we're going to apply this information to those core statements that we just went over in the last session. So in this situation, we say ABC company purchased 100 pounds of steel to make a product for a client. They paid $1,000 for the product, received the invoice, then paid out the funds. So in other words, it's a credit transaction. Then ABC sold the product that they purchased to a customer for $1,500. So in other words, in this situation, they'll have a $500 profit. And the customer purchased on credit, and then the customer paid the receivable 30 days after the purchase with a check. So now let's see how each of these transactions, we're going to go through the first one, the expense side, and I'm going to input them into those core statements so you can see how they flow through, and then do the same thing with the receipt side or the revenue side. So let's go ahead and take a look at the core statements. Okay, here's our core financial statements that we had worked with in the previous session, and this is what we're going to use when we go through these particular transactions to do this case study on the cash receipts and cash disbursement cycles. So first thing I'm going to do is I'm going to write off to the side certain numbers so we remember what they are before we start putting in these transactions. So total assets is currently $87,165. So I'm going to put that off to the side. It's hard to enter, so it's not linked into anything. Our total equity is currently $37,565. So I'm going to put that off to the side. Then I'm going to come over here to our income statement. I'm just going to take the net income. So right now the net income is $29,900. And again, all these numbers I'm putting off to the side, these are before we put in the transactions. Cash flow statement. So the cash from operations currently $37,300, and ending cash is currently $36,665. So now what we want to do, now that we have these numbers off to the side, because remember this is interactive statements, so once we start changing, all these numbers will flow through. I want these numbers off to the side so we can see what the effect is going to be on each of these statements as we enter the transactions. So first thing, if you recall, was the company ordered $1,000 of steel, and they're going to pay for the steel. They're going to purchase it on credit, and then they'll pay for it to the vendor at some point in time in the future. So first thing is we have $1,000, and we know that this is going to be something that we're going to sell in the future. And so because of that, that means it's going to be an inventory item. And so we ordered the respective product, and first thing we need to do is book the debit side. Well, we know that all assets have debit balances. So we go ahead and enter in this transaction, the $1,000 of steel we ordered. Now, keep in mind, I'm hard entering these into the statements so that you can see them flow through. Normally, you would input these into the respective modules in your accounting software and would flow through in here. You wouldn't hit the actual statements themselves. I'm just doing this so you can see how it flows through. So don't try to hard enter stuff into your actual financials. I'm just doing this so you can see how everything's going to flow through. So first part is in there, and you'll see that the balance sheet is currently out of balance. And that's because we did a one-sided entry. Remember the scale effect. Your debits and credits need to equal. So we got a debit $1,000. So that means we come down here, and because we ordered the product and we're going to pay for it sometime in the future, that means we probably have a payable. So in this case, we're going to hit accounts payable. So now we've entered the respective transaction. We ordered the product. It's going to be inventory, so we have it in inventory, and that's as far as we've gotten so far. So right now, you'll notice our total assets went up by $1,000, and our equity is still the same. But that's it. That's all that's happened. And of course, our total liabilities have gone up. So now let's see what happened to the income statement. Well, our net income is still the same, and that's because it was a capital transaction. It was a balance sheet only. We only hit the balance sheet. So nothing hit in the income statement. And then we go to our cash flow statement. Well, if you look, we just ordered inventory. Why did our cash flow operations not change? Well, the reason being is we ordered the inventory, but it was all on credit. And so we only hit inventory, we only hit AP, we didn't hit any other accounts. And so we didn't have any cash actually go out. And so even though we ordered $1,000 of inventory, our cash from operations is exactly the same, because all we did was we increased the inventory and we increased the AP. So now let's go to the second part. Now that we've gotten the product in and we're good with it, we get the invoice. And we approve the invoice to be paid, and we send them a check for $1,000. So now we need to write a check for $1,000. And so what happens is you credit cash or reduce cash by $1,000. And then we're paying a payable, so we're relieving the payable. So we get rid of the payable. So now if you look, our total assets are back in line with what they were when we started. Now, why is that? Well, that's because all we did in essence is when we purchased that inventory, we moved an asset out of the cash account and put it in inventory. Now, this is an important concept to keep in mind, and we'll hit it more in Module 3, is when you have inventory, that's your cash sitting there. So if you have inventory sitting in a warehouse, or if you're working out of your house and you have it in your basement, that's cash that's sitting there that's not liquid anymore. So that's another way to think about inventory. So have you ever heard about people saying they have too much inventory on hand? Well, when you have too much inventory on hand, you have cash tied up into that inventory. So in this transaction, our inventory balance changed. So now, go to our income statement. Again, net income didn't change because we didn't hit the P&L for anything. However, cash flow, if you look at our cash from operations, it now went down. Remember previously when we recorded the accrual entry, nothing happened. But now when we actually wrote the check and sent the cash out, our cash from operations has actually decreased. And so that's, again, important. But you see how all these transactions flow through and hit the respective statements. So now we're comfortable with all that. Now we have a customer that comes into our shop and they want to buy that $1,000 and they're going to pay us $1,500. Yeah, $500 profit. It's not too bad. But they're going to pay over time, or they're going to pay at some point in time. They're not going to write cash right away. So first thing we say is, okay, well, I have a sale, so let's go ahead, and it's going to be on receivable. So let's go ahead and do the first part of our entry. We got $1,500 because we have a receivable. Now, when you have a sale, you have revenue. So now let's go ahead and add the sale to the revenue. and there goes our sales and revenue increase. So now look at our net income. That's gone up by $1,500 by that sale transaction that happened. Now we've got another part of this entry I'm going to do, but I want you to see this part first. And then we come to our cash flow statement. Well, my cash from operations is still that negative $1,000 difference from the previous one. Why hasn't that changed? The reason being is you sold on credit. Again, this goes back to the comment I made in the previous session that an accountant can make you as profitable as you want to be. Remember, our net income before we started this was $29,900. Now it's $31,400, but our cash flow didn't change. That's the beauty of the cash flow statement. Somebody can book a fictitious revenue, and they're usually going to hit accounts receivable, and net income can go up, a ton, but the cash from operations doesn't change. And that's why this number, cash from operations, is so key. It gets rid of all the stuff, all those, what some people call the noise, to give you back to that, get you back to that point. So here we are, back to there. And then our ending cash has stayed the same after the purchase of the inventory because we haven't collected on that accounts receivable yet. So now that's just the first part of this transaction. There's another part. Now we come over here and we say, okay, we had the $1,500 sale, but we sent the product to the client, so we don't have it anymore. So this $1,000 piece of inventory, we sold it, we don't have it anymore. So we're going to get rid of the inventory, take that off the books because we don't have it anymore. Now we're out of balance again. So what's the other side of this entry? You got it. It's going to be your cost of goods sold because it's part of what you're selling. So our cost of goods sold will go up by $1,500. So then we come down here, lo and behold, our net income is now, I'm sorry, this is actually $1,000. So now we come down here and our net income now is $500. And again, I fat fingered that when I input that, but let's go back and see what happens if I hadn't caught that. If we do it this way, say, oh, what's wrong with this? Well, we're going to come over here. Our balance sheet is still going to be out of balance. So even if you didn't catch it immediately knowing what the balance should be, the beauty of this balance sheet is the way it's set up, it'll catch that. So let's go back and say, here's that inventory that we released. So now our net income went up only by $500. So what's the effect on the cash flow statement? Go to the cash flow statement. Here we are. There is what we brought in, the $37,300. Now our cash flow is still down $1,000. Now why is that? I just had a sale and I released the inventory. Well, the inventory has already been paid for and it's already been recognized in the cash flow. Now when you have that sale that you haven't collected yet, you're still going to be down on your cash from operations. So now let's go back and collect on that accounts receivable. So here is the customer just sent you the check. They said, here you go, here's the $1,500. So first thing you're going to do is you're going to add your $1,500 back in here because we just got a check for $1,500, and we're going to relieve that receivable because they don't owe it anymore. So now our assets, when you look at that, have now changed from this amount, this is the original, to this amount, which is this minus that, $500. As you recall, we purchased an inventory for $1,000, we sold it for $1,500. There's our profit, came in cash. So now let's go to the income statement. So here on the income statement again, net income is up $500 because we sold the item that we paid $1,000 for, that we sold for $1,500. It's up $500. So now let's look at our cash flow statement. Now that we've completed both the receipt cycle and disbursement cycle transactions, look at our cash from operations. It's gone up by $500. So that is how the receipt and disbursement cycles affect all your statements as it flows through. And that's why it's important to understand how that happens. And also, like I said, in the next module, we're going to go over the internal controls on those cycles. But I wanted you to get an idea, see how everything flows through. Because the problem with a lot of the accounting softwares is they have you just input in one little screen, but you don't get to see how the transactions flow through the statements. And so that's kind of one, it's out there, the software's there to be able to make it easy for you to input. But if you don't know what's happening behind the scenes, it's hard for you to grasp all the nuances as they flow through. And again, the other thing about this is if you do have a statement off, this now gives you kind of an idea as to how or where to investigate. So if your cash is reconciling and you're comfortable with your cash reconciling and something's off, then okay, well, cash and AR are probably okay. Let me check these accounts. So that's how you can kind of go down, but you need to have kind of an understanding of the receipts and disbursement cycles. Now, I went through quite a lot in this, so please rewind this if it seems a little unusual to you, or if I lost you somewhere. Go through, and these are two concepts I want you to absolutely understand. Because when we build on this and we build into the ratios and we start getting into that aspect, when we get to the ratios, we're going to start saying, okay, why is this ratio off? Why is it not consistent with prior year? Why is it not consistent with competitors? Or all of a sudden it's skewed one month. Having an understanding of the receipts and disbursement cycles will help you be able to find that, and it'll help you keep your business afloat, because you'll be able to understand, okay, if this is off, first let me check these cycles and make sure everything got input correctly or got released. So easy way to do this is if you sold the product but you forgot to release the inventory, you could be thinking, hey, I've got all this great net income. In reality, you don't, because you didn't release the product to the cost of sales. So again, this is why we have to and we want to go through this. And so the last thing I wanted to show you on this is your equity. So remember, over here on our equity, beginning equity before we started this was $37,565. It is now $38,065. Difference, there's our $500. As we said, our equity is an aspect of the net income coming in and closing out. So that's how those two transactions have flown through and affected the equity and also the balance sheet. So I hope this helps you. Again, we're building on top of this, so if this seems a little foreign to you, please take a moment to rewind and go back through it, because we're coming up on Module 3 and we're going to be going through quite a bit more. And in Module 3, we're going to be going over the balance sheet, income statement, and cash flow, but we're going to start going through how you tie out your accounts, how you do a bank rec, how do you analyze your accounts receivable, how do you analyze your inventory. We're going to be going through all of these. So all these respective line items, we're going to start analyzing these and show you how. And then we're going to build the ratios. And we're going to go through this actual core statement again, and we're going to start building on top of this. So I hope you've found this informative, and I look forward to seeing you again up here on Module 3. Thank you.